I'm going to show you how to make consistent money in the markets every single month. So if we look right now at the SPY, price has just absolutely tanked, and in the last couple of days, because of all this talk about tariffs and stuff, price has just fallen off the edge of a cliff. So what we can do here is we can play the contrarian. Okay, we don't trade based on direction, but just to have a small directional bias, it doesn't matter. We're just going to play the contrarian here, and we're going to say price has come down a lot, so we're hoping that prices are going to reverse maybe a little bit, stay where it is, but hopefully not go down too much further. But if it does go further, it's fine, we can still make money, and I'm going to show you exactly what I mean. So you want to open up a list of option expiration dates, and you want to go over to something that's around 30 to 60 days out in time. You ideally want it to be a monthly, not a weekly or quarterly expiration. And we've got one here, May 16th, 39 days away. We're going to open that up. Now we can see the options chain. Because we are going to be having a small, long directional bias, what that means is we want to sell puts. Okay, so if we were to buy a put, what does that mean? If we were to buy this 495 put, what that means is we're going to pay $21.74. So basically going to pay $2,000. That's our debit. We're going to pay that. We need price to move lower than 473 because we're paying the premium. So we need price to go way below this in order for us to actually start making money at expiration. Okay, so if price goes higher, we lose. Price stays where it is, we lose. If price goes lower but not low enough, we lose. So there's only one win condition, and we have a pop of 37%. Okay, if you were to sell this instead of buy it, our pop is now flipped. It's 63%. It's the opposite now. If price stays where it is, we win. If it goes higher, we win. If it goes lower but not lower than 474, 473, we make money. So we have a lot more win conditions. Okay, so we're going to sell puts. Whenever you're selling or short a contract, you want price to stay away from that contract. Okay, so we're going to sell some puts. I'm going to sell at the 30 delta. So we've got a delta column here, 30 delta, 471. We are going to sell that. We can go to the 470, but we will collect, it's not much, it's $20. It's $20 difference, but just 470, it's a round number. So we'll just sell the 470. And as you can see here, we're going to have a pop of 73%, a P50, which means your probability of hitting 50% of max profit is going to be 84%. We're going to collect 1.4 up front and our broker is going to require $7,000 in buying power. So we're going to collect 1.4, our broker is going to use 7,000. Now, you might not have 7,000, you might not want to allocate 7,000. So what you're going to do is just buy another contract a little bit further out, say $5 out. You're going to buy the 465. So you're going to sell the 470, buy the 465. So we're going to collect more here than what we're paying here, which means we're going to have a net credit of $1.13. So now in this case, we have a P50 of still over 80%, max profit of 113, and our broker is going to require under $400 in buying power. You can widen this out if you wanted to, collect more, use more in buying power, have a higher pop, a little bit higher P50. You can manipulate this to basically fit your requirements for buying power, okay? But basically, this short leg at the 470, that's the trade. And you're just managing buying power with this long leg here. So that's exactly what you need to do. You just want to do this over and over again for many different underlyings as possible, and have as many occurrences as possible. Let the odds work out in your favor. Eliminate short-term variance by keeping your position sizing small. And the way you do that is by using our position sizing template. The link is in the description. You enter the size of your portfolio, you enter in the VIX level, and everything's going to be calculated for you. This is an example of a defined risk position. So if we look at the guideline, maximum amount of buying power to allocate to a single defined risk position is $500. In this instance, this would fit inside this example portfolio. And that's exactly how you use this. If you wanna, the link for this is in the description, by the way. If you do want to learn in more detail, click on EDS Premium, get yourself signed up. You will have access to this exact portfolio that I showed you in the video, where you'll be able to see all of our trades, etc. Everything in real time, all our management, adjustments, everything. There's a full course inside as well, so no prior knowledge is required. We will teach you everything that you need to know. It's a private community, so if you get stuck, you can speak with myself, with other like-minded individuals. There's a 100% money-back guarantee as well. So once you have been through the course, follow some of our trades for 6 months. If you are not profitable, we will work with you for free until you are, or you can request a full refund. So it is completely risk-free. It's $9.99 a month to join. The price will be increasing, but once you're in, it's locked in for you for life, so you are rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. Once you've learned it, no one can take it from you, and we expect it to take about 6 to 12 months for you to be completely self-sufficient. So with that being said, I will see you guys on the inside.